Okay, I said this Monday, but we have 56% of people watching this show are not subscribers of this show. So over half of you that are watching these videos are not subscribed. I would love to see that number go higher. I've actually seen most YouTubers are sitting at about 90% of viewers are unsubscribed. So we're doing pretty well at 56%, I must say. But I'd love to see it higher. And if you're enjoying the show, all I'm asking is please subscribe. Please become a subscriber of the show. And also there's a bell icon that YouTube have introduced a long while back now, but if you click on that, it will give you notifications every time we upload, which would be awesome. So if that's something that might be useful to you, please click it. And it also tells me that 20% of people that watch these videos have that bell icon clicked, so awesome stuff. Today we're going to take a look at a company called Dunelm, so let's take a look. Hey there guys, welcome to the FTSE show with me, Chris Chillingworth. So today we're going to take a look at a company called Dunelm. This is the home kind of gardening, furniture, home stores sort of company that most of you watching, if you live in the UK, will know of. And I was interested in this company because they're a retail company, but they're doing okay. There aren't many companies out there in the retail sector that are actually getting decent numbers, and Dunelm aren't doing too badly. So yeah, I'm not going to kind of blabber on too much. We'll talk about pricing at the end and we'll chuck them up on the leaderboard and see how they get on. But let's dive into those numbers and take a look and see Dunelm. Okay then guys, let's take a look at Dunelm then. Epic code DNLM in the FTSE 250. These guys are in the retail sector, of course. So we've got data going all the way back to 2008, and as we can see here, we've got some really strong revenue growth on year. These guys have been growing very, very nicely. Back in 2008, we're sitting at just shy of 400 million. Then 2009, 423, then 492, then 538, 603, 677. 730, 835. In 2016 we're at 880 million, 955 in 2017. Then they breached the 1 billion revenue mark in 2018, sitting at 1 billion 50 million. And then 2019, 1.1 billion. So every single year we have consistently seen revenue growth without fail, which is great. This is a company that's clearly growing and clearly doing things right. I'm not sure what they're doing, but they're doing it right because they are growing very nicely. Then we can look at the cost of sales, and ultimately, once we've extracted cost of sales, we're left with the gross profit. Now, what I like to do is I like to look at the gross margin. If you've been watching my show in the past, you'll know this is pretty much standard for me. I look at the gross margin. That is essentially the percentage of the revenue that these guys keep once cost of sales have been taken off. So we've got the revenue, we deduct the cost of sales, and we're left with the gross margin. The gross margin has been rising, so that means that they're getting a bigger slice of the cake. This is a good percentage to go up. That's the percentage. We want the percentages to go up here. So in 2008 we're looking at 44.6%. Then we're looking at 48% by 2011, and we've pretty much been stuck at 48 to 49% every single year, just shy of 50% in 2019. So we have again seen a margin growth. It's not been huge. It's gone up about 5%, just shy of 5% over the last 12 years. So that's not been, huge, but it's still growth. It's still slightly edging off every year a little bit more of the gross profit for themselves, or for the shareholders. So that's very good work. Looking at the expenses, starting at 2008, we're looking at 72%. Now, there have been years where it's fallen down as low as 67%, and it pretty much stayed at that level from 2010 down to 2014. So, it's down there in the sub-70s for quite some time. And then we kind of breached back above the 70% mark at 70.2, 70.5 over 2015 and 2016. Then 2017 we saw a spike in company expenses, jumping up to just shy of 80%, sat at 81% in 2018, so it didn't go back down. And in 2019 we've seen that drop down to about 77%, but we're way higher than we were, during that sub-70 period between 2010 and 2014. So expenses have definitely gone up recently at a higher rate than the gross profit has been increasing. We've got no big deals of depreciation of all that at all. Interest on debt is very, very low, which means I expect they're not really borrowing much, but we'll see when we get down to the balance sheet. And then we come down to the net earnings. So 2008, 2009, these guys were making about 9%. Decent enough, it's average, it's not amazing, but it's secure. and it's, I'd be happy with that. Looking at 2010, we're looking at 11%, and we stayed at 11%, and then we reached 12% in 2012, and we stayed at 12%, and then we kind of fell just shy of 12% in 2015, 2016, but this is a company that have been making between 11% and 12% from 2010 to 2015. So these guys, 2010 to 2015, sorry, 2016, so 2010 to 2016, doing very well, making a good, solid 11 to 12% net earnings a year. You really can't balk at that. That's very, very good, especially in the retail sector. A very difficult sector to make hardly any profit. We've seen so many retail companies on this show so far, on the FTSE show, over the first 44 episodes. Most of them are getting nowhere near 11-12% in terms of net earnings. This is a company that if I was looking at this from 2010 to 2016, I would have been very, very interested in Dunelm. However, we have in the last 3 years seen a bit of a decline in the profits, falling to 7.6% and 7% in 2017-2018, jumped back up to 9.2% in 2019. So it was a good year for Dunelm, 2019, a big step forward, a big step up again, but it's definitely declined since their kind of the special period between 2010 and 2016. They haven't got back to where they were yet. 2019 was a good one-off year. It's broken that downward trend as well, because they've jumped back up to 9%, but it's still a concern for me. They're not back to where they were before. I hope it's the start of something more positive for Dunelm, that they're getting back to those previous 11-12% net earnings figures, but we won't know yet. And obviously with 2012 kicking in, that's going to be a damaging year for them, I'm sure, because they're in the retail sector, and pretty much every retailer has been damaged by the events of 2020. But for me, those numbers are a bit low, and that trend is a bit of a concern for me. Obviously, expenses have been going up as well. So there's a couple of little warning signs there that might suggest that this is a good company, but not quite good enough, but we'll see. Looking at the balance sheet then, they've only got 19 million in cash. There were days when they had 65 million in cash, so it's a lot lower than what they have had in the past. Current ratio has been falling, as you can see here. 2013, they're sitting at 2 times the liabilities. So current liabilities, current assets, 2 times the amount of assets against liabilities, but that has been falling, and we're now down to 1.4. So that's a slight concern. It means that liabilities, short-term liabilities, have risen faster than the growth in short-term assets. What I will do is I will spin all the way down, I think, to debt levels, of which there's nothing in the short-term debt, and there's only 44 million in the long-term debt. That's not a concern for me at all. This is a company, even at 9.2% net earnings, they were making 101 million, and they're only borrowing 44. So they could easily pay off that debt whenever they want, essentially. That is just, they're just rolling that over, keeping them ticking, giving them a little bit of extra cash to do something with. That's absolutely fine. I've got no issues with that at all. That doesn't raise any concerns for me. So looking at the equity of the business, the equity was as high as 207 million in 2012. And then from 2012, we saw a decline going into 2016, where essentially the equity of the business halved. It went down to 99 million. And now, in the last 4 years, we've seen that starting to go back up again. That's promising. I like that. I like a company that's growing in equity. It means that they're doing something right. So obviously that's going to be the longer term stuff. So looking at the retained earnings, this is at 134 million. Again, we've seen a similar pattern in that from 2012 onwards, the retained earnings was falling. Now we're starting to see it turn around and start going back up again. So that's good. We're seeing about 30 to 50% increase in retained earnings, which is very strong. It means that there's definitely a focus on money being pumped into that. And the return on shareholder equity has historically been very favourable, which essentially means that the return, the profits that this company is making off the amount of assets and equity that they own is very impressive. It means they don't need to own a hell of a lot of assets to make good profits, which is very good. I like that. I like a company that's like that. And capital expenditure looks absolutely fine. So all in all, this is a company that are really close to the sort of company I would invest in. This is a very good business. They're doing very well. I love the revenue growth. The expenses have been rising a bit too fast. That's one very minor issue for me. It's something I would keep an eye on. I wouldn't want to see that going above 80% and into the 85s and 90s. If that was starting to happen, I'd start to worry. The net earnings, unfortunately, I don't like the fact that it's dropped sub 10% after they've been doing so well. I don't like a company that's falling in net earnings. I want to see companies grow, and all the companies that I tend to invest in are those companies that are growing. And it's all well and good growing in terms of revenue, but you want to see the profits going with that. And unfortunately, the profits have been going in the wrong direction for Dunelm in the last 3 years. So I'd need to see some sort of a turnaround with Dunelm over the next few years, and you'd have to discount 2020, I think. But during the recovery, you want to see them getting back to that sort of 11-12% over the next few years before I would be interested as an investor. But they're really close. They're a very good company. I think they're going to score decent on the leaderboard, but they won't be one of the best companies I've seen, unfortunately. Let's go and take a look at the chart. Okay, so this is the chart. We're looking at 2008 onwards. So they went through a nice strong period, and then as you can see here, from 2016 down to 2019, we've seen the price drop from £10 a share down to about £5 a share. So it was halved about 50% over the course of 2016 down to 2019. And then in 2019, we've seen a proper jump. Look at that, from 2019. Now, if you remember, 2019 was a decent year for them. And after several years of some slightly worrying trends in those numbers, 2019 then picked back up again. The net earnings jumped from 7 to 9.4, I think it was when we were looking at it just now. Jumped in terms of net earnings. So it was a bit of a turnaround for the company, and obviously the share price has reflected that. As you can see, from 2019 we jumped all the way back up to £9 a share. And then the company had a very, very good December 2019. The price jumped within a month from £9 a share up to nearly £12 a share. So it did very well. Obviously 2020 then came along and ruined the whole thing. As you can see, the month of February, the share price actually went up to £14.50 before crashing all the way back down again as the market began to crash. We saw the price fall all the way back down to £6 a share. And this has been one of those companies that has recovered almost fully since the crash at the beginning of the year. We can see the share price now back up to £12 a share, which was pretty much, obviously barring that spike when they went up to £14.50 in February, pretty much back to where it was pre-crash. And we're starting to see a few companies reach that point now out there. Having done all this analysis on all these companies, this is something that I'm starting to see, is that a lot of companies have recovered already in terms of their share price. That's a concern for me, because with the economy in the state that it is, obviously Dunelm haven't released any numbers for a little while. We don't know how badly affected they've been by the events of 2020, and for the share price to be this high, that we may see that fall back down again. I don't know. I might be wrong, but for me, I'd want to run some analysis, and we'll look at pricing in a moment when you come back to me at the leaderboard. And we'll look at pricing in a minute and see whether or not we're getting a good deal at £12 a share. I suspect that's probably going to be higher than it should be, but I might be wrong. We'll have a look in a moment. But that's my concern, really, is that any company that's already reached its pre-crash value before they've even released any numbers about how they've done during the first and second quarter of 2020, that's a little bit of an issue for me. It might mean that price may correct somewhat once those numbers get released. They may not have done as badly as I suspect, but I suspect in the retail industry they will have done, and they would have had a poor period. But let's go and take a look at the leaderboard then and see how they got on there. Okay, so Dunelm plc, not a bad business, not a bad company at all, but they've got some trends going on there that I'm not particularly keen on, and it's just going to knock them back a little bit, unfortunately. Looking at the price, currently priced today at time of recording at £11.80 per share. They've got an earnings per share of just shy of 50p a share. So that works out about 4.1% return, which would suggest that £11.80 is a little bit too high. This is really common. You look across we've analysed now 361 companies so far this year. We've got another 700 odd to do. Mostly AIM companies left to do now. But what we found in those first 360 companies that we've gone deep into, and we've looked at a lot of information, is that the vast majority of companies across the FTSE 100, the 250, the small cap, the fledgling indexes are overpriced. And it's very surprising to find so many companies now out there that have returned, or at least or have even breached the pre-crash price of 2020. So the price they were sitting at before the big crash in February, they are back there. In fact, most of them, or many of them, are higher than that. And that's a concern for me, because most of them haven't released their numbers for Q1 and Q2 of this year. And we don't know the impact that the economic situation is going to have on these companies. So how can they be worth more now than they were at the beginning of the year? It doesn't quite make sense to me, and that's a concern. But yeah, £11.80 a share. Taking a look at the actual assets, or the net assets of the business, you're looking at there's 202 million shares. The equity in the business is sat at 185 million. That works out about kind of net asset per share about 91 pence, which is about 7%, or a price to book ratio of nearly 13. So all this is pointing towards the fact that Dunelm's share price seems to be far too high for we're actually getting as an investor, as a buyer. If you were to buy all of the shares in Dunelm and be making yearly about 4.1% return on the price you're paying today, it wouldn't be a great return. So that's suggesting the price is too high. Having run some numbers and crunched some of those numbers, we're looking at, for me, if I was going to be interested in buying Dunelm, I would need the share price to be around £6 a share, which again, is a long way down. And this is the issue, you see. You'll find a lot of press and a lot of media articles talking about the fact that the stock market, and many of the stocks in the stock market, are far overpriced. And we saw this with the dot-com bubble, and we saw that bubble crash. Now, we've already had a crash in 2020, but there are a lot of people out there that are suggesting some darker times ahead for the stock market. So, I mean, there are always people predicting darker times ahead. There always have been. You don't have to look far to find those sorts of people constantly making predictions that bad times are ahead. It's very difficult to know what's coming. I'm not in the business of trying to predict when a crash is going to happen. Is a crash going to happen? So all I really focus my efforts on is, am I getting good value for my money, for my capital? Is putting my money into this business going to be good value? Am I getting a good return on the money that I'm investing in? And there are a handful, and I really mean, I've looked at 361 companies so far, and about 40 of them tick my boxes and look like great businesses. A small handful of those companies, of those 40, are currently priced at a price today that make great value for money. Unfortunately, Dunelm are not quite good enough to make my top 40 companies, and the price is just too high. They wouldn't be invested anyway. But let's get them up on the board. Well, I'm going to need a black pen, new black pen soon. Costs of the show are rising. So, Dunelm score a very mediocre, not very impressive 49 points. Listen, I think that's fair. They do have some issues. There are some slight concerns there. I think this is a decent company to invest in. You could do a hell of a lot worse than investing in Dunelm. But they do not strike me as a company perfectly set up to be that kind of big 300-400% growth kind of company. Yes, revenue is growing, but there's some other concerns there that we saw in the numbers, and that's what knocks their score down somewhat. 49 points is still respective. It's still decent enough. They'll be on the leaderboard now for quite some time, but yeah, not the standout, super exciting company that I would be ploughing my money into. I'm not invested in this particular company, but you might think differently, and that's fair enough. So let's get them up on the board. Okay, so you might not be able to see them, but they're all the way down here in 18th place. So, you know, they'll stick around for a while. They're a half decent company, kind of average, not really a standout business. But yeah, we lose Oxford Biomedica, which I'm sure many of you are crying over, because probably none of you have ever heard of them anyway. But yeah, they're off the board now. They are gone. Very surprising that we're likely to lose Domino's and Cineworld off this board. These are companies that historically were doing really well, but if you watch those shows that we did on those two companies, things have been turning sour over recent years, and unfortunately their scores have been hit pretty badly, likely to be kicked off the board, which is a surprise. But yeah, so before you go, I've got one more piece of news that I wanted to share. I did report on this on Monday, but as of September, we're going to be doing a third show of the FTSE show a week. Not sure what day of the week that's going to be just yet, but I put a video out asking people what do they want to see, because I was thinking maybe we'd do some Belgian stocks or some Norwegian companies or some European companies, but the overwhelming majority of people who commented on that video were after more AIM analysis, FTSE AIM analysis, so the smaller companies, the alternative investment market, and so we're going to do that. That's what we're going to do. The people have spoken, and we've decided that's what we're going to concentrate on. So as of September, we're going to doing a dedicated FTSE AIM show. We're going to do a new board for it. So we're going to completely bring in a whole brand new board and start from fresh and start building a leaderboard of AIM companies only. So that hopefully will be interesting, or hopefully scratch the itch for some of you that might be interested in seeing some analysis on some of these much smaller companies. I think it'll be entertaining. There'll be some great stuff in there, and there's going to be some absolute dog turd in there. So that'll be interesting to see. That'll start as of September, so keep your eyes out for that. Like I said at the beginning of the video, if you haven't subscribed yet, please do. If you enjoy this video, please subscribe. Please click the bell icon as well to be notified of future videos. Thank you so much for your support, guys. I genuinely appreciate all the comments, all the likes, all the emails that I get from people saying thank you and well done. I appreciate it all, and it's awesome. So thank you so much, guys, and I'll see you next week. Cheers.